Hi, everyone. This is Jason Bjerk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Silver has become a hot topic lately. It's one of the top performing commodities on a percentage basis, except for today where it's had a correction the last couple of days. It's down to around $30 an ounce, but it's rocketed up, I think, from 24.25 up to around 32 before this latest correction. We have one of the top silver experts. He put out a book in 2022 called The Great Silver Bull: Crush Inflation and Profit as the Dollar Dies. He also has solely a silver newsletter. All it does is cover physical silver supply and demand for bullion, for premiums, and then for silver companies and silver producers and junior explorers, called the Silver Stock Investor. He has over 20 years experience in their natural resource markets, and he was a former portfolio advisor. Peter Krauth, thank you for joining me today.
Well, Jason, thank you so much. Thanks for that intro, and I'm happy to be here. Looking forward to our conversation.
So we're recording this interview on Thursday, May 23rd, 2024. I want to ask you about the Silver Institute reports that have been coming out for years now. So what are we on 4 consecutive years now of supply deficits according to the Silver Institute?
Yes, exactly. So 2024 will make year number 4, and this will be the second largest deficit after 2022. So they're expecting a deficit of about 215 million ounces. And if you add together these last, well, including let's say this year, assuming they're right in terms of their numbers, we're going to be somewhere around, I'd say, or over 600 million ounces, which is very big because total mine plus recycling supply annually is about 1 billion ounces. And it's actually been falling despite demand rising. So that's really interesting. So a straight year of deficit, and they forecast deficits almost as far as the eye can see going forwards. It's quite the bullish setup.
So you said that the deficit now is approximately 600 million ounces, and that's what with investor demand growing outside the United States, that's with industrial demand growing, and then supply problems.
Exactly. So, as I say, fourth year of structural deficit this year, and large deficits. Mine supply at best is flat. They're actually forecasting that that overall supply will fall this year, just 1%. I think it could even fall a little bit more. But silver miners are just absolutely struggling to find, build, and get mines up and running. So in terms of the mine supply side, it's very tight. Recycling, we're not going to see much more recycling come to market. If we actually see a 30 hold, which I think we will, perhaps not in the very short term, but I think 30 will become a new floor in silver. But that can encourage recycling to some extent. But recycling has also been stalled around the 180-ish million ounces a year, representing about 15 to 18% of annual supply.
So for gold, there's been articles coming out for the last month or so that a lot of Americans are selling their gold jewelry, cash for gold. They're kind of cashing in, desperate for cash. I don't think we're at a silver price, though, on a relative basis with the gold to silver ratio where it is, where a lot of people are going to do that for silver. You brought up the silver recycling. I mean, I've read David Morgan, who the silver guru, you're another silver guru just like you. David's put out 2 books on silver, a smaller book, and then the Silver Manifesto a few years ago. And he was talking about how there's billions of ounces of silver in landfills, but we're nowhere near an economic price for that to be economic to go into the landfills and try pulling out small, minute amounts of silver.
Yeah, I mean, David's right. I know David well. He's a wealth of knowledge in the silver space. I really respect his work and his opinions on things, and I agree with him. I think that one of the key things about silver and recycling silver is that it is used in very small amounts in so many of its applications that it is not worth essentially, the effort and the time and the costs to get that silver back. So if we're able, perhaps in the future at much higher silver prices, to actually go back and find that silver in landfill and then process it and get it back out, it may at some point at a much higher price be economic. At this point, I just don't see it. It's small amounts, very small amounts. We're talking sometimes cents or a couple of dollars worth in a device. It goes a long way things like electronics, on-off switches, um, processing chips, you name it. So it's found in all sorts of electronics, in EVs, the big application that's really just absolutely mushroomed over the last decade or so is solar, and we can talk about that a little bit more. But that really has become the single most dominating industrial use of silver in the last several years, and it's continuing to grow. And even there, recycling is pretty much non-existent, and yet even more silver is starting to go into each and every panel because of technology changes.
And solar panels have to be replaced way more often than people think. Those solar panels by themselves, especially if they're exposed to harsh conditions in the desert, wind, rain, other types of extreme weather, they do not last 10, 20, 30 years. I mean, I've seen people that have installed solar panels at their homes and they're replacing them after only like 5 or 6 years now.
Hmm. That's a great point. Costs are cut. In fact, costs have been falling on solar panels, which is one of the reasons that adoption has grown so much. It's still there's a lot of additional capacity beyond what is being used to produce, and yet we're producing at record levels. But you're right. Part of it, I think, is quality has fallen to drop the price, and so that's a consequence of it. You end up having to replace the panel sooner. So that being said, you lose that silver even faster. With such a short replacement cycle.
The stuff you mentioned with the silver in each like electronics, those are like silver contact switches. They have those in cars and smartphones and computers. Those are like a couple grams of silver at most. It's not even a 1 ounce coin. So it's not economic at the current silver price, probably not even economic at $100 an ounce silver for 6 months or a year. I mean, silver would have to probably be triple digits for many, many years for anyone to even think about doing this on a wide scale, removing all that silver out of, thousands and thousands of tons of junk in landfills.
I completely agree with that. Exactly. The amounts are just too small to justify. And so that's going to stay in those, unused devices for a very long time until we actually find it's useful and economic to go back and get that out of there.
I want to ask you about the inventories on the Shanghai Gold Exchange and the discrepancy between the price for physical silver on the Shanghai Gold Exchange or bullion dealers in China. I think it hit the premiums, the differential, $4 an ounce difference between the silver price in Shanghai or Shanghai Gold Exchange or in bullion dealers and here in the US. Do you think that's because demand in China is one of the main areas and they're having problems sourcing supply?
I absolutely do. And it's interesting. It's a great point because, we've seen that. It's clear. It's a clear fact that that's what's going on over there. I was actually told anecdotally by a relatively large silver producer whose production goes half to the West and half to China. And so they, really have a feel for the pulse of what's going on in China. And their Chinese buyers are telling them they are prepared to pay for the silver 2 weeks before delivery, and they are willing to pay $3 to $4 above spot price in order to absolutely guarantee their deliveries of silver. So
Is that
China.
skip? Is that, sorry to interrupt you, is that skipping the refiners and the exchanges then?
Um, That's a great question. That is not something that that this mining executive got into. I don't know if what purity they're delivering to the mining company. If that's, I know it's some sort of an offtake agreement, whether that has to go through refining still before the buyer actually gets their hands on it. I'm not sure. My guess is that it probably does have to go through that. Um, he simply said that they were willing to pay, as I say, $3 to $4 above spot to get their hands on that silver. I would assume that that's on the fully refined, the final product. of silver that they're going to use. Could be, and most likely it's silver grains, and that's what is easiest to work with to melt down and do have your use for your own applications afterwards. But as I say, I when I started to see all these posts about how in China the price of silver is, as you said, $3 to $4 easily above spot versus what it is in the West. That didn't shock me. This is something I had heard about 2 or 3 months ago. So yeah, definitely something for us to keep our eyes on. I think industrial and individuals, so industrial consumers and retail consumers, I think are really actively buying silver in China.
And the Shanghai Gold Exchange has, with current silver demand levels, which are very, very high, under 45 days left of physical silver inventory. Where do you think they can get the inventory if they need to go buy more? Because can they go to the LBMA? Can they go to COMEX and go buy them? Or are there also inventory problems there? Where do you think the silver would be sourced if the demand continues at those levels in China? Where would the Shanghai Gold Exchange, which is a physical exchange, where would they be able to source the silver from, in your opinion?
So yes, I would agree that the COMEX, the LBMA, these are, two places where they could go. What's interesting is that we've seen inventories in the LBMA and in the COMEX fall overall in the last, I'm going to say 3 to 4 years by about 40%. So that certainly has been drained, at least to some extent. What's really interesting is that the LBMA stores also for a lot of the ETFs around the world. And even more interesting is that although the overall inventories are down about 40%, if you look at what they call registered inventories, which is what's actually available for delivery. So this is the true available silver that if you have a contract, you can actually get your hands on, and that's down about 70% in the last 4 years. So the markets, I believe, are much tighter than we realize. I had been asked several times, especially over the last maybe 6 to 9 months, how come the silver price seems to have a ceiling at about, say, $28 or so, and yet we're facing these structural deficits. Where are these consumers getting their silver? Well, I had strong suspicions it was going to be from the futures exchanges, from the ETFs. And so I started doing some research, was able to get data on the LBMA, the COMEX, the Shanghai, and silver ETFs globally. And the average is down about 40%. As I say, the registered inventories for silver on the LBMA are down 70%. And what really I found interesting was the silver ETF holdings. So some of that could be, in terms of the drop, could be, simply investor apathy. If you look at the SLV ETF, so that's the first silver ETF created in 2006. Today has about $11.5 billion market cap. And so I was curious to see what had happened with two things when it comes to SLV. The silver ounces held, so the actual physical silver that they're supposed to have, and that's another topic, but assuming they have it, the number of ounces that they hold, as well as the number of shares outstanding. So the shares outstanding in SLV is an indicator of, sentiment basically towards that ETF and silver in general. And both silver ounces held and shares outstanding are down. I'm going to say also about 40% in the last 3 to 4 years. Now, what's interesting about the SLV is that I have access to charts that go back to inception that show me, that plot both the price of the units, which is essentially mimics the silver price, and then the level of either both outstanding shares and silver ounces held. So here's what really is really, really interesting. So I brought up these charts, and then I looked at, again, I'm going to repeat, excuse me, but silver ounces held versus unit price. And outstanding shares versus unit price. So there are three periods that really stand out. First of all, during the financial crisis, you had a considerable drop in the silver price. So let's say from about late 2007, early 2008 until early 2009. So silver price dropped. So what happened to the silver and to the silver, the number of ounces that they held, and what happened to the shares outstanding? Well, those went up while we experienced a considerable drop in the silver price. So that was interesting. People were still buying the ETF. They had to keep accessing silver to back their outstanding shares. The next period that's interesting is during or after the silver price peaked at $49 in April of 2011. So at that point, silver starts to go into a long-term correction. It goes from about $49 all the way down to, I'm going to say 30, let's say 30, 25, $30 over the span of about, say, 2 years, 2.5 years. Well, if you look at outstanding shares in SLV, if you look at silver ounces held by SLV, that after a small correction at the very beginning of after silver peaked at $49, essentially moved sideways. There was no significant drop in the ounces of silver or in the shares outstanding. Fast forward to early 2021. So through the sort of middle part of, or I'm going to say Q2, early Q3 of 2020, when the COVID pandemic hit, you had a huge run up in the silver price. You had an outsized run up in buying of SLV, and especially into the peak in early 2021 when we had the silver squeeze. That was January of 2021. And of course, through that, you had a huge run up in outstanding shares and silver ounces held in SLV. And then it peaked. And interestingly, at that point until today, we've had what I would call a consolidation. And except for this recent breakout in the last few weeks, you've had a consolidation. Silver was somewhere between, say, $20 and $30, mostly between $22 and $28. Well, interestingly enough, that is the first and only sustained period of falling silver ounces held and falling outstanding shares in the SLV ETF. In its 15-year history, that had never happened before, despite huge corrections in the silver price. So we've had, I'm going to say apathy, not disdain necessarily, but apathy for the silver price, and yet the silver held by SLV has been dropping. I think that you've got large consumers, probably large industrial consumers, because you need to own typically millions of dollars worth of units of SLV if you're going to go to the issuer and say, I want physical silver in exchange for these units, which you can do with nearly all ETFs, physically backed ETFs. So I think that these big consumers are tapping both the futures exchanges and the physically backed silver ETFs, and they're getting their silver there. That's how the silver price. So they've been able to access above ground silver stocks without that silver having to be actually produced, actually being mined. So imagine you've got this consumption of silver going on every year, assuming it's, let's say, a steady amount. Assuming it's a growing amount of consumption, but you've got a flat and insufficient amount of mine and recycling supply to meet that demand. So the demand is still being met somehow. And I believe they have been able to tap these above ground secondary inventories and draw them down, which they've done over the last 3 to 4 years without pushing the silver price up. And I think that that game is going to be over soon. I think we have 12 to maybe 24 months at most before these inventories become fully drained and someone's going to go to the exchange and say, okay, I've got a long silver futures contract. I'd like to take delivery now. And the exchange is going to have run out. And they're going to say, oops, sorry, force majeure. I can't deliver. I'm going to have to pay you out in cash. And they're going to say, no, 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 I don't want the cash. I want the physical silver. And we're going to hear about that. And that's going to be a starter's pistol. And it's going to really, really cause some havoc in the industry.
There was actually a lot of stories about that, the cash settlement. I think the premiums were around 80% in 2011. It was only for a short
Yes.
amount of time when you had a big silver spike a long time ago, not a couple years after the global financial crisis. And then they announced the quantitative easing programs. And then you had the silver price spike. I think it got as low as what, $12, $13, and then you couldn't buy that price if you wanted to buy retail bullion coins and bars on eBay during 2008. And then by 2011, I think the silver price hit what, 49, and then the exchanges were running out of metal. They were raising margin requirements and premiums like crazy. And then I think like that the margin requirement hikes, and then they settled out the futures contracts, I think at 1.80% cash settlement. There were stories about that on Zero Hedge when the blog was first created.
Exactly. Yes, exactly. And then think back to 2020. I remember quite clearly, uh, when the pandemic hit, people were trying to get their hands on physical, and the bullion dealers were just not able to meet. And there was, I mean, the demand versus the supply in this matter of months, and it went, in fact, a few years. We're still, I believe, we're still not back to what was, say, pre-pandemic normal levels. But I heard stories about how in India you had premiums going up to 100% over spot. People were so desperate to get their hands on physical silver, they were willing to pay double the spot price to actually get it. And for at least a few years after the pandemic had hit, you were still at 40 to maybe 50% premiums over spot, which is close to, that's about triple of what's normal. 12 to 15% premiums above spot is what is considered normal. And for years, after the pandemic hit, we were still at 40 and 50%. And we're still at above historically normal levels. So the market is very tight, and the physical premiums are certainly alluding to that.
What you brought up with the price differential with the $4 an ounce in China versus the COMEX, the US price, if the bullion banks, the custodians of, say, SLV, I mean, they have the easiest access to the metal. It would be easy arbitrage for them if they could take silver tonnage and then ship it to China, or get a refiner to turn it into the coins and bars that the Chinese consumer wanted, or industrial end users, solar panel makers in China wanted, and they could collect the spread there. That would be easy for them. So I wouldn't be surprised if they were doing that for the last couple of years too.
That I agree. I agree. There's odds are probably quite high that sort of thing is going on as well. Definitely.
Well, but like you said, it's going to eventually clean out the inventory at the exchanges. So, like, that's why you're going to see lower numbers at the LBMA, at the COMEX, and then also with the SLV, the trust, because the custodians of the trust, they can basically do what they want according to the rules of the prospectus. I mean, they get away with so much. And then it seems like every year the lawyers that are in charge of the prospectus that work with the banks, they just keep issuing like wide legal loopholes into the prospectus.
I agree with that as well. Yeah. In fact, I've heard stories about the kinds of claims that there could be on a single ounce of the number of claims there could be on a single ounce of silver at some of the ETFs. And so I would really do my homework and be very, very particular about which ETF I was buying if I wanted to be sure that there was physical silver there.
Well, in general, I've told people, because I've followed like Trace Meyer, who was a lawyer, and he was looking at the GLD and the SLV. He made a YouTube video over a decade ago, still on YouTube, going through the
Mhm.
prospectuses there. And I'm sure they've changed. I mean, they update the prospectuses each year, so I'm sure it's even worse now. The Sprott Physical Silver Trust has 150 million ounces or thereabouts. I think it was 150 million a year and a half, 2 years ago, of
Mhm.
physical silver there. So, and sometimes that physical silver trust that even trades at a discount to the net asset value.
Exactly. And I must say that is, I've done some research on them. That is the one that I am most comfortable with, the Sprott Physical Silver Trust. And yeah, I mean, if I would start my research there, I have the most confidence in that one, most definitely.
But I think one of the major points you're making, though, is that if you're a Chinese solar panel manufacturer or you're Apple and you're making smartphones like your iPhone or other Apple computer products or Samsung, you're an industrial end user, you might consider skipping the exchanges altogether. I mean, if you want the physical silver in a certain way, if you want more than, say, 1,000 ounce industrial bars, you want it customized, you're going to probably skip the exchanges and you're going to start to go to the refiners then with the orders for industrial users.
Oh yeah, absolutely, and that is something that they do. They have offtake agreements with silver miners. Uh, something that's probably worth mentioning is the amount is the silver is a very particular market or a very particular metal when we talk about mining of silver because about 70-ish% of silver does not come from primary silver mines. Only about 30% comes from primary silver mines. That 70% of silver is actually mined from deposits that are mostly gold or copper or lead and zinc. And so a 70% of mined silver depends really on the mining of other metals first. And silver is a byproduct. So, the miners of that silver, which is a byproduct, aren't that motivated by the silver price. The silver price can could run up tremendously, and because it's such a small revenue source for their from their mining, they will just happily take the higher price and not try to make any adjustments to produce more silver. Like I say, it's just such a small stream for them, and I think that to go back to your point, you certainly have all kinds of industrial consumers that will go to miners like that and buy those streams from them, those streams of silver, and lock that up for years in advance. And especially these days with the markets being so tight, they're willing to pay spot, and as I mentioned earlier, sometimes above spot. So they're willing to lock in, not necessarily lock in quantities over time, but not necessarily lock in price because they know that someone else will come in and be willing to outbid them. So typically, at least spot. These days, we're talking spot plus, and it's a question of getting material. It's so many of the applications of silver are in applications that where the silver is just truly indispensable. You cannot replace it. The solar panel industry that we have today would simply not work without the silver. And something interesting to mention about the solar industry is the technology, the changes in technology. So until about a couple of years ago, there was a dominant technology called, these are all acronyms, but this was called PERC. And there are two more advanced technologies that are starting to take over a lot of the manufacturing capacity. So the next one after PERC is called TOPCon. And the interesting thing about TOPCon is that it produces more energy output than the PERC technology, but it also requires up to 50% more silver per solar panel. So, you know, the solar panel manufacturers, obviously, they do what we call thrifting. So they try to squeeze out as much silver and anything else that goes into the panel that contributes to costs so that they can lower their costs. But now, as the technology shifts to TOPCon, where you're using 50% more silver per panel, even if you're being as thrifty as you can, that's a lot more silver. So the thrifting has shown gradually less and less, at least I think until perhaps we're going to see those numbers change this year. But at least up until last year, we saw the amount of silver going into a single solar panel had been falling and then flatlining over the last 10 years. I believe that we're going to start to see that is going to start to trend upwards. In other words, the amount of silver into each and every solar panel will start to trend upwards. The big reason is what I just mentioned. The new, more dominant technology is becoming the TopCon one. And there's research from multiple sources that has estimated that this year alone, half of solar panels manufactured are going to be using the TopCon technology. So even more silver is going to end up going into the solar sector.
And you said before we started recording that solar panels are the fastest for industrial demand growth for silver.
Absolutely. Just breathtaking numbers coming out of the Silver Institute. I'm going to say that, when they gave their forecast last year, they had said, to expect a certain amount of growth. In fact, I tried to track that as best I can, and trying to look for some of my research that I don't remember it exactly offhand. Here we go. 2023. So these are interesting numbers that really look at the silver sector as a whole. So the supply forecast was that supply was going to rise by about 2% last year. When it got revised, it was revised down 1%. So despite huge growth in demand, and a forecast for supply to try to meet demand growing by 2%, it actually fell by 1%. They thought industrial demand would grow by 5% when they revised overall industrial demand. So this includes all kinds of things, solar panels, EVs, electronics, and any, medical. They thought that industrial demand would grow 5%. It grew 14%. Within industrial demand, they thought solar would grow 28%. That was revised up to 64% just last year. They thought that the supply deficit would be 142 million ounces. That got revised to 184 million ounces. So, just I don't know. I don't know what to say.
Well, aren't global silver inventories? I think I saw a chart going around. Maybe it was you that posted in the last week or week to 10 days. Aren't global silver inventories? They're down almost 500 million ounces
That's
in
right.
just the last
Yep.
18 months or something.
That's exactly right. That was a chart that was put out by Sprott. They tallied up the futures exchanges and the ETFs. And you're right, that's down 400. It was, I think, 480 million ounces. So that goes to show you these secondary or above ground inventories are absolutely being drained. So you've got some people arguing, saying, well, you're just sort of fear mongering. There's a lot of private ownership of physical silver, and I'm sure that there is. But how willing are these people to part with their silver, even at $30 or $32? Well, I guess we'll find out. But, I just think that the kind of environment that we're in, high inflation, lots of geopolitical tensions, lots of uncertainty, risk of recession, stagflation, controversial elections. I mean, I could go on and on. Banking crisis, sovereign debt crises. There are black swans just all over the skies. And so, I mean, I just have a hard time believing that holders of physical silver are going to let go of. I mean, there are always some who will, but are going to let go at these kinds of price levels when I think the true diehard physical silver investors are going to be holding out for the long term, and they see silver going to much higher prices, and I believe they have no intention. The vast majority have no intention of letting go of their silver until silver prices are considerably higher. So I do not think that prices in the 35 or even $40 range are going to really start to contribute a lot more physical silver to the market. That there is a lot of physical silver that is difficult for us to quantify, but I think it's unrealistic to think that those holders will let go until much higher prices are realized.
Well, I also think that there's a permanent trend now in place because of this global debt crisis. All these central banks, governments and central banks, seem to have a government debt problem, or almost all of them. And they seem to, at this point, I'm hearing a lot of other central banks want to start cutting rates. They don't want to raise interest rates anymore because the governments can't afford interest payments on the debt. So they're going to let the inflation rate run hot. There's going to be debt monetization. There's going to be currency debasement, and it's starting first in Asia. The dollar on a relative basis versus other currencies is relatively strong, but that's not the case in Japan. It's not the case in Korea. It's not the case in other Asian countries. And Indian silver, I think a lot of it was investment demand. Indian silver imports just hit an all-time high, I think, back in March.
Yes, exactly. That's right. And it's interesting the point you made about allowing inflation to run high. That's exactly the point I make in the book, The Great Silver Bull. I do believe in the section where I talk about more macroeconomics, view and aspect of the silver market. Just to understand things in general, that I believe absolutely that is what's going to happen. It's a way to monetize the debt, and by keeping rates low, well, you kind of accomplish two things. One is that you continue to stimulate, and you also make it easier for debtors who will have a hard time, paying those debts. If you look at the U.S., for example, in the last, this is, I think, Bank of America that made this estimate. They believe that in every 100 days, $1 trillion is added to the U.S. national debt. And there's a phenomenon called debt spiral, and that is when you have debt, when you have deficits that are so high and rates that exacerbate the deficit, uh, that you have to quite literally print money just to pay the interest on your debt because it has become so high. And that's what leads to sovereign debt crisis. And interestingly enough, I've been looking into this, and there is a group called the Council on Foreign Relations, and they have a sovereign risk tracker. And they recently said that they as far as their research is concerned, they are now at a record 12 countries where they see a very high risk of sovereign debt crisis, not to mention another dozen countries that are all officially in default. So it won't take much. It just seems like there are just so many things that are sort of teetering on the edge, and it will just simply not take much to push things over. We haven't even talked about things like banking crisis, for example. But to come back to your point, you talked about India. Yes, they're very, very savvy when it comes to silver. They tend to buy when the price is relatively weak, sentiment is bad, and they tend to sell when sentiment is rich. And the silver has become overpriced. Well, they are, one of the things that's interesting, and we talked about this before starting the interview, but I had mentioned that the International Energy Agency sees India as one of the places, in fact, the area to have the largest energy demand growth of any country or region over the next 30 years. And we've seen huge increases in solar module manufacturing capacity. That's going to have tripled between this year and 2027 alone. They imported in February of this year alone over 70 million ounces of silver, which was equal to 64% of 2023's imports. So the Indians are, as I say, very silver savvy, becoming even bigger silver consumers. And there's an interesting phenomenon which I've researched, written, and talked about in the last few months, and that is how places, I guess you would basically say in the East, that have become more and more, have grown their affinity to silver over gold, and like, I guess you could kind of say silver has become the new gold for them because gold has become so expensive. So if you look at, for example, I believe it was Turkey, they've been facing for the last year or two over 65% annual inflation. In the last, I believe it's 4 or 5 years, silver price in Turkey is up 700%. If you look at Egypt, for example, in the last 2 to 3 years, the silver price has doubled. They've been facing huge inflation as well, and they have a strong affinity to gold culturally. The Egyptians tend to buy it as gifts for newlyweds, for the bride. They tend to give it as gifts for newborns. And they're starting to say, I can't afford the gold anymore. I'm going to start to buy silver gifts instead because gold has become just too expensive for us. I read another article, anecdote on that very same topic just recently. So that is really what's happening on the ground. People are really turning to silver more and more because gold has become too expensive, and it's a hedge of multiple types: a chaos hedge, an inflation hedge, currency hedge. I could go on and on.
And silver is the people's money. So I think, like you said, that's a permanent long-term trend for a lot of emerging market countries and Eastern countries, where a lot of investors that would have purchased gold in the past due to the nominal price, even though it hasn't kept pace with like the consumer price index, the gold price hasn't in US dollars. People are just saying, well, I'm going to buy more ounces of silver, even though like if you buy a lot of ounces of silver, it's probably difficult to store it. But let me add too that one of my buddies from graduate school, he got married a couple of years before the pandemic. And he was telling me that for Indian brides, for the dowry, that a lot of the dowries now are not just physical gold like they used to be. He said it's more of a 50-50 mix between gold and silver. And he said basically over the last 10, 15 years, that's a permanent long-term trend now in
Wow,
India.
so that's interesting. See, I had not heard about that in particular, but in a sense, not too surprising. Like I say, there was huge demand. People are when they look at. You have to be careful when you look at numbers. But what's interesting is that in 2022, there was huge outsized demand in jewelry, in silverware, and in physical silver for investment purposes. This, according to the Silver Survey from the Silver Institute, huge numbers. It was 234 million ounces for jewelry. It was 73 million ounces for silverware, and it was 337 million ounces net physical investment. And then, so that was 2022. Those numbers were down anywhere from about 13 to 28% from 2022 to 2023. So people will look at that and say, oh, sentiment is waning. People are not interested in silver. I think that's the wrong way to look at it because those were just huge outsized numbers. A lot of that was driven by India for the same reasons that we just mentioned. And what has happened is they, in some ways, I guess you could say, binged and overstocked, perhaps in certain ways. And of course, the silver price had run up, so they're good buyers. They wait for better bargains. They got those in 2023, which shows even although, as I say, those numbers had come off between 2022 and 2023. They are forecast to rise again, and the 2023 numbers were still above 2021 numbers. So even if you factor out completely 2022, we're still clearly in a rising trend in each and every one of those categories. So you can have these outlier years. They're exciting, but and people have all kinds of opinions about these kinds of surveys and so on. I say, at the very least, they are always indicative of trends, and I think that's tends to be the biggest takeaway from that kind of research.
So I want to transition now to the supply side for silver. And I think this is something that a lot of people, other than you and maybe Steve St. Angelo and myself, miss. I think there's a lot of developing problems on the supply side for silver because, like you said, the majority of annual silver production is a byproduct from either gold mines, copper mines, or lead and zinc mines. One of the major things that I noticed that people who are bearish on silver, they never talk about the supply side because they say, oh, silver stuck at $18. Oh, silver stuck in a trading range at 25. Well, if the ore grades, Peter, are going to keep collapsing and the cost to mine with all the input costs, labor, electricity, cost of capital with higher interest rates, all these costs are going up. We're going to be looking at much higher new normals for many different reasons with all the cost rising and the ore grades falling right on the supply side.
I completely agree. I mean, the cash costs in 2023 were up 61%. All in costs were up 25% for silver production. The miners' margins were down 30% year over year because of cost inflation. And then if you look at the reserves, primary silver reserves were down. Year over year from 2022 to 2023. So that really tells us that they have been struggling to replace what they're actually mining out. And M&A, which is, tends to be indicative of, I guess, in some ways, the health of the sector and the outlook and health of the strength and the outlook of the sector. Well, M&A, if you look specifically at primary silver mines, that dropped to its lowest level last year since 2006. So there's not that much activity. I mean, supply's down again 2023, and it's forecast to be down in 2024. These miners are struggling, and when your margins are squeezed, you have little incentive to spend money on exploration to try and grow your output. And you get what you get is a couple of things. If a company is relatively strong, I'm going to say financially sound and financially strong, they'll do a couple of things if they can. Some will perhaps decide to just sit on some of their output. I've seen a couple of companies do that. Mexican producers, US and Canadian listed Mexican producers have decided to just sit on some of that, stick it in their treasury, and sit on silver. Some have decided that they're going to go the next step. They've set up their own mint. This is something that First Majestic has done. They've decided to set up their own mint in Nevada, and they want to capture the difference between the spot price and the ultimate price of the physical silver when it's sold on the retail side, whether it's bars or coins, whatever. And so they would really like, over time, if they could actually move all of their production through and sell that as mint product, because then they capture all of that premium on the physical output. So these are really, really interesting trends to watch. You're right, ore grades are falling, exploration dollars are falling, M&A is falling, costs are rising, reserves are depleting. It's a very, very, very challenging sector. But what it does bode well for is those few companies, the best of the best that are finding deposits, that are finding rich economic deposits, ideally multi-hundred million ounce deposits. It is happening. I mean, I spend my days, doing research, looking for these companies and trying to focus on the best ones. Those companies are out there and they've done well. I mean, one was added to the portfolio back in mid-March. It's up about 43%. One was added in mid-April, and that one is also up, I think 45 or 48%. So as I say, it certainly helps to have the silver price run up, but these are multi-hundred million ounce projects. You're looking for obviously jurisdictions that are friendly towards silver mining, and it's challenging. But I believe that these companies that have the best mines, the best or the best deposits, really sort of ones that stand out globally, are going to be the ones that perform the best. I've often heard that when the M&A starts to kick in, the larger producers are going to turn their attention first to the 100 plus million ounce silver equivalent deposits. And they're going, when you talk about equivalents, that's a whole other ball of wax, which we could get into. But silver equivalents basically mean that you take the credits from other metals. Often that's either going to be gold, or it could be lead and zinc, and you convert the value of these other metals into silver, and then you say, okay, I have X number of ounces of silver equivalent. I'm difficult when it comes to that. I feel that there are a lot of companies that masquerade as silver companies when really they're not. They actually really are more gold copper producers or lead zinc producers, and they have perhaps 15-20% of their output or of their deposit or of their revenues from mining is actually from silver. So I just move those aside. I don't even pay attention to them. For me, it has to be at least 40-45% revenues from silver, and then I'll start to pay attention. That's when we're looking at really what is more of an actual silver company, whether it's a deposit that's not yet being mined, or it is an actual miner that is pulling the stuff out of the ground. So yeah, I mean, you need to consider all of these things when you're investing in the silver space.
I was actually going to bring up how over the last 10 or 12 years, a lot of primary silver miners are not primary silver miners anymore. A lot of it was out of survival, though. You brought up mergers and acquisitions. It depends on the environment. I mean, during the bear market in 2015, 2016, 2017, a lot of companies had to do mergers and acquisitions to survive. They had to reduce overhead, cut costs. There wasn't capital available. So it depends on the environment. If the miner's being aggressive, like in 2010 or 2011, to add a large deposit for growth, to show investors that, hey, we are adding reserves, we're adding a growth project, or if they're merging in mergers or acquisitions out of necessity just to survive. It depends on the environment.
Oh yeah, no, exactly. That's something that we've started to see more, not quite yet in the silver space. I've seen it more in some of the base metals and in the gold producers, or even explorers, in terms of merging and consolidating. But there has really not been too much going on in the silver space. I think that's going to be a telling sign when we start to see that happen.
And during the bear market for silver, when silver price peaked in 2011, and then there was a bear market for 8 years or so, give or take. I mean, a lot of the primary silver miners, because of the profit margins, were just easier and better on copper and gold mines. I mean, they went and bought gold mines. Hecla went and bought, I think, 3 or 4 gold mines. Coeur d'Alene went and bought gold mines. Pan American Silver bought a couple of gold mines, copper and gold mines in Mexico. It was out of profit margins and necessity just to survive. So I think what Peter's saying, the point now is that as silver starts to trend higher out of supply side problems, rising costs, those new ounces, they're going to be looking maybe for the next acquisition phase for growth. They're going to be looking at silver deposits, especially if silver goes over $35 an ounce.
I completely agree. Yes, that is. I think that's what we're going to start to see. That's going to start to make things really exciting in this space.
The one issue there with the silver as a byproduct, and unfortunately, this is just because of how expensive it is to build a copper mine. I mean, a medium-sized copper mine is, I think, at least $1 billion to build it. So that's 10 years of permitting, drilling, developing, permitting, feasibility studies. You got to get a banker to give you some debt. And then these copper miners, still a lot of them have to go and sell like a gold or silver stream as a byproduct to like Silver Wheaton. Oh, not Silver Wheaton, Wheaton Precious Metals. Sorry, they changed their names because there's not enough silver byproduct stream. Wheaton Precious
Right.
Metals or Franco Nevada. So that's how like over the last 10 or 15 years, that was part of the funding package now to sell the silver byproduct streams. The base metal miners, the copper miners didn't really have a choice.
No, that's a great point. You're right. I mean, a lot of it was out of survival, which basically caused the silver space to shrink even more. If you're, like I say, my cutoff is about 40%, and if you use that, you're really looking at a small pool, relatively small pool of quality silver producers. Whether it's large, whether it's medium sized, small, and then the developers, and then even the explorers from there. And you can have one looking for silver, end up finding something else, and then from one day to the next, they're not even a silver explorer anymore, they're a copper explorer. So these are the kinds of things that you have to really navigate and contend with. But it's a very it's certainly a particularity of the silver space. And really, actually, it kind of leads to opportunity, because with the space being so small, when attention turns to silver in a really, really big way. I mean, it's like trying to. I'll quote a longstanding fixture of the junior research industry, Doug Casey, who says, it's like trying to get the contents of or force the contents of Hoover Dam through a garden hose. You have so few quality silver names to pick from. That really they just explode, and we've seen that sort of happen in the last couple of months. I mean, I look at the portfolio that I have in the newsletter, and you've got anywhere from certainly the larger names moved first, but then in the last month or so, the small names have really, really started to move. And you've got anything from, I'm going to say, in the last 2.5 months or so, when almost 3 months now, when things really bottomed in at the end of February to currently, you're looking at anywhere from about 45% to, I think in one case, about 160% return from that bottom. It's just been tremendous in the last 3 months. So that really, really is a good taste of the kinds of things that are to come in the silver space.
Now, any of the companies, have they actually gotten all the funding required with feasibility study and then from a bank to actually go and build a mine, or are we not there yet in the capital cycle?
I mean, there are always a few that because you've got if you look across the space, there are always a few who are at different stages, and yes, I mean you've got some that are even in fact expanding now. There are a couple of names that have not had much difficulty, raising the money that they need to build out their mine. One in particular is about, I'm going to say about 55, 60%. They're going to start with a new mine at the end of the year. It's high grade silver. It's going to help almost double their production, which it's interesting. The market doesn't care until all of a sudden the market cares. Well, I can tell you that about 2.5 weeks ago, I was actually in their offices in Vancouver, and that day, before I went to meet with them, I was looking at the portfolio, and their stock was up. I mean, I'm talking about $1 billion company. Their stock was up 20% in the first few hours, triple normal trading volumes, and it just goes to show you that with silver moving and with good leverage to the silver price, and a company that has been underappreciated really will absolutely turn on a dime. And that company added about $200 million to their market cap in the first few hours of that day. There's another company that is a relatively large silver producer that is bringing an expansion of their mine online. And that is set to happen probably in the next couple of months or so. And they are going to quadruple production. This is one of the world's few pure silver mines. And I'm talking really nice high grades, 5, 6, 700 grams per ton silver. It's the only thing that comes out of the mine. There's no other byproduct. It's a true anomaly. And as I say, that one is about to quadruple their production, and the price. That's been a true exception. Sentiment has been tough until recently on the silver space. That one's been an exception. That was added about a little over a year ago, up about 75% in about, I'm going to say 14 or 15 months. So it's done really, really well. Again, you pick the quality names and then you're patient with them. Chances are, obviously, no guarantees, but chances are that overall they will reward you.
Yeah, I've been tracking the silver ore grades for many years, for over a decade, and the average silver grades have collapsed. They collapse like every 5 to 7 years. They
Yeah.
don't get cut in half necessarily, but they can fall like 30, 40% very, very quickly. It just is shocking. It's happened to Pan American Silver. It's happened to a lot of the other larger silver miners, that they start getting to like the edges of the deposit, and there is still resource there, but it's lower grade than what was projected for the initial phase of the deposit, or during the bear market, they high graded. I think we're headed below. Would you agree that in the next under a decade, we're headed below 100 grams per ton or less average silver ore grades for a lot of these primary silver mines?
Yeah, I would think so. I mean, if you look overall at the industry, that's a fair statement. And an interesting point about ore grades is, again, a particularity of silver is that if you have the silver price run up, what what you can have is some producers will say, well, now that the silver price, let's just use a hypothetical example. We're at $30, let's say, and silver runs to 40 and stays there for a while. And you've got a miner that says, all right, well, this is nice. Uh, Fantastic. I can accept $40 price for my silver. But really, $40 is really a good price. Why am I going to mine the highest grades from my deposit when I could turn around, move to the lower grades, make the same dollar profits, and actually produce less silver? So you could have the opposite effect happen under a scenario of a higher silver price, where the miners just decide they'll do what they have to maximize or even keep perhaps profits the same under and actually have to produce less silver so that they can preserve their higher grades for potentially even higher prices in the future. So it seems perhaps counterintuitive, but it's in fact been miners who've told me that they've done or they've considered doing this.
Well, I would say that we know this from the past, from the bear market, and then also when gold and silver prices did spike in 2010, 2011. I mean, the costs for a lot of the miners back then, 2010, 2011, they were rising faster than the metals prices. Not only did you have like a shortage of like truck tires and workers, other costs rising, you also had like a lot of the miners were undisciplined with their profit margins. They weren't mixing in the mine plan with the high grade ore in there. They started putting in the absolute worst grade ore that was borderline uneconomic when silver got to 49, and it destroyed their profit margins and their free cash flow. It pissed off a lot of investors.
Yes, agreed. They were not they were not very good stewards of their own companies and resources, and the shareholders punished them for it, and rightly so. I think it's just it's unfortunate that they seem to lose reason when they see that kind of very favorable price environment, and they certainly have to be a lot more. I mean, we also blame them. It's not an easy job. We also blame them for sometimes being too conservative, but that certainly got out of hand, and yeah, it's, I guess, perhaps in hindsight, not too surprising that it led to almost a decade, long consolidation and bear market in the commodity space. It really happened across, I feel, across the entire commodity space after you had the huge run up from about 2001 to 2011. And so we've had a reckoning, but I think we're in a multi-decade secular commodities bull market. Some people are saying, oh, well, we're kicking off a new bull market. My personal opinion is that it started back in about 2000, 2001, and that this is sort of a secular bull market, kind of a generational one. And that the first half from about 2001 to 2011 went through a correction. A lot of the resource prices corrected in half. Gold is an example. Silver is an example. Gold bottomed in December 2015 at $1,050 after peaking at 1,900 in, I believe it was September of 2011. So yeah, one example. And I think that we went through that correction that lasted almost 10 years, perhaps depending how you measure it, 6 or 7. But in any case, and I think that we're on the cusp of the second half of this secular bull market in commodities. And I think a lot of it, at least at the beginning part of this renewed bull, is going to be driven perhaps not so much by demand, perhaps more by supply shortage. And that I think as we evolve in this portion or the second half of the secular commodities bull, and we see stimulus start to kick in, then I think demand is going to be the bigger driver of much higher prices.
I was actually going to ask you that for my last question as we wrapped up the interview. So you mentioned demand that's going to be increasing for certain types of metals and cheap energy for data centers, artificial intelligence, and electricity
Yep.
usage, other food commodities. But I also see supply problems too. And a lot of it is because of government policies. It's not necessarily because of the free market, it's because of government policies. I see copper and silver supply. It looks like they're in permanent downtrends in Chile, Mexico, Peru, Panama. Do you think that that trend's going to continue because of not necessarily free market, or if the copper price goes to 6, it's because of the protesters and the government saying, oh, we're going to raise royalty taxes if the copper price or gold price goes to these levels, or just basically, ESG, they're going to say, oh, we're not going to allow permitting for the mine at all.
Yeah, absolutely. I mean, we're seeing that in a lot of Latin American countries, not exclusively, but certainly we're seeing it there quite a bit. And it's unfortunate because they talk about ESG, and at the same time, you need silver, you need copper to electrify. So it's kind of wanting your cake and eating it all at the same time, and just isn't going to happen. And yet, if a big if the green transition is the answer to it, then they should be uh, fostering mining with open arms, and I'm not saying that allow it to be a free for all. That would be crazy. But if you've got miners, and I do believe that the vast majority today really do work to develop and run their mines in a friendly, environmentally friendly, responsible way, environmentally and socially responsible as well. Um, I think that it's just very misguided to treat them that way. They're basically cutting their noses off to spite their faces, and it's unfortunate because I think that we are going to come to a point where people complain about the mining companies. They want more from them, but by wanting more from them, the you hurt supply and you drive price up. So your final product all end up costing you more. So perhaps if if these actors that have issues with mining uh, somehow have some kind of an epiphany or a revelation and realize that, oh, you know what? We're on the wrong side of this. This is the answer. More and more, you're getting, I'm going to say, former protesters and former groups that have been difficult, towards this sector really are waking up. They're realizing, uranium is a tremendous answer to our energy needs. Uranium, if you look historically, extremely safe as an energy source, despite the issues that have had. Yes, there have been, there's been 3 Mile Island, there's been Fukushima, there's been Chernobyl, but look at the number of deaths. Look at the number of affected people over time, and that's I believe that's the fair way to look at it. Look at that versus the amount of energy that these sources have put out, and you also have to be fair and look at the reasons that these accidents happened. But um, hopefully, I don't hold my breath, but hopefully, collectively, we come to realize, how we need to be looking at these sources of energy, and mining. You do not have a green transition without mining. It's that simple, and you also don't have a modern society without mining. So hopefully, we come to realize that.
Same thing for cheap electricity too. Wind and solar aren't going to cut it for all the data
No.
centers that are being planned by big technology and all these other types of new technology company, governments, credit card companies. It's just not available. You can't rely on wind and solar. Germany has had problems with this for the last 10 or 15 years. They invested heavily in wind and solar, and their manufacturers, their chemical companies, just they couldn't compete. So they had all these problems, and a lot of German companies are moving their factories outside of Germany now.
Absolutely, and in fact, I remember it was shocking that I can't remember quite what industry they were in, but it was an incredibly old company, something like 600 years old, in Germany, an industrial company of some kind, not a brand name, just but some company that's just been around forever, and they actually had to shut down. They had to close after 600 years of operating because of the issue of energy when they could no longer buy natural gas from Russia and were faced with suddenly much higher energy costs. So we're not we're not collectively we're not great stewards of or we're not great managers of energy, it seems, especially when governments become involved and geopolitics become involved in it. Private industry just seems to do clearly a much better job when it's left alone, but unfortunately it's rarely left alone.
There's issues with all forms of energy. So coal, natural gas,
Yeah,
liquefied natural gas, nuclear power. There's plus and minuses with all of them. Nothing's perfect. But I think like a lot of people that have been anti-nuclear, they're slowly starting to realize that look, we can't have cheap electricity, and we can't you can't have both cheap electricity and then also not deal with environmental problems. There's issues with all this stuff. And then the other thing is people don't want an extra $1,000 a month electricity bill. You're a small business owner, you get hit with an extra $1,000 a month electricity bill. No one wants that either. So you can't have,
exactly.
yeah. So it's just a major issue. There's metals problems too, and I see mining costs rising, ore grades falling. This is a long-term trend, so I think we're going to have to see higher silver prices. Same thing with copper, and we're going to need more investment into cheap electricity too.
Absolutely, absolutely, and silver really, in many ways, because of its properties, is on the cutting edge. They're in the silver survey for 2024. They talk about how research has shown that silver nanowires actually randomly they self-assemble to form a network, like of something they call crossing strands. And these networks they respond to a continuous stream of data, and they learn, they adapt in real time, kind of like biological synapses in a brain. And these networks, they process information much faster. In fact, something like closer to the speed of light, much faster than electricity. So, silver is kind of a wonder metal. Its uses, its applications are I'm going to say almost limitless. There are patents that are being filed very regularly for new applications for silver. And it's in the book I call it the Swiss Army knife of metals, because it just has so many uses. It's essentially half money and half industrial metal. Very unique in terms of commodities.
Well, Peter, you're a wealth of information on silver. I did not get the stock pick names out of you for the silver companies that you tease. My listeners will have to check out the Silver Stock Investor and also your book. Now, your book is available on Audible audiobook too, right?
It is, yeah. So you've got print on Amazon, you've got Kindle, you've got Audible audiobook, and yeah, there's three ways that you can get to hear or read the Great Silver Bowl. My goal was really to not make it academic, to just take the whole silver opportunity and bring it to someone who maybe starts from scratch, knows little or nothing about silver and the whole environment and market of silver. So I really go through macro. I go through history of silver, then I go through macro. Then I talk about the supply demand side of things. I talk about what drives silver, what's specific about drivers in the silver space, and ultimately how to build a portfolio, and then how and when that you'd eventually want to sell, because we're going to get, I think, perhaps within the next 6, 7 to 10 years, we're going to reach a peak in silver. We're probably going to go through a mania like we did in 1980. And you're going to want to take advantage. You're going to want to take advantage, cash in, and make the most of it. So I talk about how and when you'd ultimately want to sell into silver highs.
Well, even if silver doesn't go through a full mania, I think like based on all the stuff we discussed over the last hour plus, I see higher price floors. I mean, silver 35, silver $40. A lot of the mines that were found over the last 15 years, they were found back in 2011. Those mines need 35, $40 an ounce silver to stay there for the capital to be raised to build those lower grade, high resource total number, but lower grade, higher cost silver deposits going forward.
That's exactly right. I completely agree. As the ore grades fall, that is one of the best justifications for higher prices if you're going to actually have supply come to market.
Exactly. And that's why the primary silver miners, they didn't have a choice. I mean, I've seen people online just bash like First Majestic Silver, Coeur d'Alene, Hecla, Pan American Silver 15 years ago. I mean, if they hadn't bought gold mines, they'd probably be looking at bankruptcy sometime over the last decade. They had to go buy gold mines. They didn't have much of a choice. The profit margins were better for gold mines, but now they can start to look at silver again if silver is back in a bull market and it's going to be trending above 35 going forward.
I agree with that. Like you say, it's easy to criticize until you're in those shoes. And probably for the most part, they did do the right thing. And now the right thing is going to be to start looking at acquiring large quality, permittable, mineable silver projects. And they are out there. And that's what I try to focus on, both on the exploration and on the development side in particular with the companies that are in the portfolio.
Exactly. And I think people aren't aware because there's a lot of people that are new to silver over the last 3 to 4 years. They're not aware how bad things got during the bear market, Peter, like 2015, 2016. I mean, I was getting emails, phone calls every day asking if Wheaton Precious Metals, well, they were Silver Wheaton at the time, Pan American Silver, other silver producers were going to go bankrupt. I was getting like nonstop emails and phone calls about, are they going to go bankrupt today? The shares are down below $5. What should I do? What should I do? That was a buying time for some of the companies.
That's right. I mean, if you bought Wheaton Precious Metals, I'm going to say, I don't know, back in about 2005, 2006. So, okay, you're going on, yep, nearly, say 18, 19 years now. That thing is up 800% at least. There was a period in the late 2000s, I believe it was 2008 to 2011, silver wheaten stock. So this is after the big correction and during the financial crisis. Silver wheaten stock was up 17 times. So this is one of the world's largest publicly traded silver related companies. And you could get that kind of return in a matter of 3 years in this space. So it's the leverage can be tremendous. And you do not have, Pan American did a similar kind of return over a longer period. I think it was probably about 2003 or so to 2008. You had a similar return in Pan American, again, one of the largest publicly traded silver companies. I mean, again, you can get these tremendous returns by being in that market, and you don't have to be, necessarily investing in some of the higher risk junior explorer companies. These are big companies that will pay you dividends, that have been around for decades, that have proven themselves, and I believe, like you say, are really going to start to turn their attention more and more towards silver as the silver price runs up, as the gold silver ratio comes down, and markets in general start to favor silver more and more.